So now we turn to Europe, and we wanted to start off with this chart because it shows that there was some decent sized moves in the Eurozone composite PMI, which increased to 54.1 in April versus 53.7, which signaled that further acceleration of growth. But some cracks have started to come into this number, not because April was wrong, but because of the deceleration that happened in April into May. And we've seen a slowdown in construction. We've had some surprise numbers to the downside in Italy, which was one of the big drivers of these increases, which is why, one of the things that we were saying is yes, this is good, but there's still cracks beneath the surface. It's just, when does the service side reflect those problems? Because the consumer has been stronger versus even, our expectations by far. So now the question comes down to, the Eurozone aggregate side. So Eurozone composite was expected at 54.4, came in at 54.1. Services was expected at 56.6, came in at 56.2. PPI month on month was expected at negative 1.7, came in at negative 1.6. PPI year on year slightly higher than expectations at 5.9%. But then when you look at what the ECB did in May, they raised rates, which was our base case, was rates were going to go up. Our view is that rates are going to keep going up. And we're going to show you why we believe that over the next few slides. So again, nothing too surprising in that deposit facility, everything there, but the retail sales is what starts to tell the story. Because when you look at retail sales, the expectation was for negative 0.2, came in at negative 1.2%. That was in March. So again, we still saw the service side bump, but you're starting to see these cracks. The cracks on the consumer front. Investors' confidence was expected at negative 7.5, came in at negative 13.1, which was much worse than April. So you're seeing some of those cracks essentially pick up heading into summer, which is one of the things that we've been talking about on the EIA show when we discussed the softness in summer spending. There's an expectation that we're going to get this huge surge of activity. And don't get me wrong, activity will go up in the summer. It's the summer, people travel more, they do more. It just won't be to the same degree of the expectations that are here. Eurozone, is the consumer strong or weak? And this is what we keep going back and forth with, and I thought this was a great chart. Eurozone consumer data is giving that mixed picture. Sentiment is depressed, but the willingness for major purchases is in 12 months is coming back with consumer credit, which is growing despite rising interest rates. So is this a sign of weakness or a returning of optimism? And I think it's a convergence of both. You're seeing them converge together because, there's got to be this kind of balancing act, but we do think that it's going to move down into a negative plane after you see some of that pressure point, because the ECB is going to have to keep raising rates. And I think that's the conundrum here, because there was a view that, and when you look at some of these surveys, there was a view that the ECB was going to stop. But as you're starting to get some of this reacceleration of inflation, you're starting to get some of these problems, the ECB is coming to the conclusion that, hey, we can't stop. And I think as that starts to price itself into the consumer and they start to come to terms with that, that's when you'll see that walk back and you'll see some of those slowdowns, which is why the Eurozone market implied changes in the overnight rate have continued to go up. So the ECB's data-dependent approach means any views on what could happen in 4 months may easily shift. But policymakers from across the spectrum of the government and council are speculating that 2 further quarter-point hikes may not be sufficient to tame consumer prices. That is a concern, because if you look at euro area inflation rate, it actually peaked up a bit. Core inflation actually moved up a bit. It's not coming down. If you remember, for the charts that you may have seen, or I have at least shown you on core inflation, was your expectation of this increase and then a drop. And our whole thing is look, it's going to stop going up, but it's not going to just fall off a cliff. That's not the way this type of inflation is going to interact, and you're seeing that play out. Now, the German PMI orders minus inventories, Italy, Austria, Poland are all showing these pressure points. European data are starting to look worse. Headline PMI indices, black, are falling sharply across the Eurozone and Poland and are everywhere below the critical 50 threshold. Weak data are going totally under the radar because everyone's fixated on euro going up to a 1.2. But again, the problems are there, especially when you look at orders versus inventories. There is an underlying problem between those two, and that's where I think that we can find a way to kind of get over this. And I think that is what we can look at from this perspective of, okay, well, how much worse can we get? And I think orders are telling you it's going to get worse. Now, it takes time for that to come through because, again, the data on the service side has been pretty good, but now this is starting to show some of that softness coming through and that acceleration to the downside, which again becomes an underlying problem. European Central Bank balance sheet assets, the chart is showing the ECB has already reduced its balance sheet by 1.1 trillion from peak levels, but the policy stance is simply unsustainable and the global economy cannot withstand such a significant withdrawal of liquidity. But when you look at the liquidity put in, you have to appreciate that a lot of this was put in at negative rates. So if you look at the amount of liquidity that has been put in going back to 2014 and forward, there's so much that's still sloshing around that there's some view that it's like, look, it's unsustainable. It's like, well, the liquidity that went in was unsustainable. So now it has to come out, and it's going to take time for that to happen, which is why the ECB is coming to the conclusion that this is a bigger problem. When we look at Germany, again, showing some of that catch up on the issues, imports were expected to be down 2.1%. They were down 6.4%. Now, exports were also down more than expected. But again, the imports is showing the underlying problem. Service PMI slightly better, pulling German composite up. But factory orders were expected to be down 2.3%. They were down 10.7%. German construction was at 42. Last month, they were 42.9. So service is still that sticking point, but everything around it is cracking. Industrial production expected to be negative 1.5, came in at negative 3.4. Again, all of these levels, while CPI was expected at 0.4, came in at 0.4. Year on year, 7.2. EU harmonized 0.6. So again, it's flat from March. So everything on an industrial level is getting worse with inflation not getting better. And again, that's where we see some of this breakdown. And Germany is showing some real cracks again. France, the composite was expected to be at 53.8, came in at 52.4. And a lot of that was because services underwhelmed. Expectation 56.3, came in at 54.6. Wages slightly better at 1.8, but industrial production, same thing. Expected at negative 0.4, came in at negative 1.1. Manufacturing production expected flat, came in at negative 1.1. You're seeing the pressure. And these are the two largest countries in Europe. And in an industrial level, on a manufacturing level, they're rolling, and they're rolling hard. Now, if you go back 2 slides from what we talked about, their new orders are grossly negative. And then when you factor that with inventories, it's even worse. So again, there's not any real protection here, which is why we see this getting worse and worse. German factory orders, just giving you an idea on the order side, showing that breakdown. Again, there's just so many issues when we look at where we sit. And again, you're looking at the expectation negative 2.3, came at negative 10.7. But then when you look at the compared to 2015, we are seeing that additional slowdown, which is why we were saying that Q1 finished slower, and that continued into April and May, which is, again, what's playing out here. German construction back down to the lows. Housing activity, it's worse than COVID. It's worse than what it was. It's at 36.8. Again, none of this is positive for sustainable growth. Eurozone retail sales, you can see that continuous negative moves. Eurozone retail sales by volume came in at negative 3.8. Again, all of this is showing that it's still positive, though. So again, to be clear, it's still positive on the Eurozone retail sales chain to 2015, but on a volume basis, the volume is now rolling. And that's where, yes, services is still positive, but moving in the wrong direction, which is, again, confirmed by new orders, confirmed by the increase in inventories, creating some of this underlying stress that is not going away. Italy showing some more cracks with, when you look at total composite, slightly worse, but retail sales were expected to be negative 0.5, came in fairly flat. But the industrial side is where we see the problems. Again, it's everywhere now. Industrial production expected to be at 0.3, came in at negative 0.6. Industrial production year on year coming in at negative 3.3. Then when we look at Spain, composite was expected at 58.5, came in at 56.3, and all of that seeing the same pressure points to the downside. Now, when you look at some of these pressures, some of these underlying issues, we're seeing a continuous push. We're seeing more problems. We're seeing, again, this cracking, which is happening at the worst time. And it cycles back to what we talked about in the EIA show, where European driving is slowing. And that is, I think you're starting to see why, where you're starting to see that pressure and it's not getting much better, which is, again, why we see some of these underlying slowdowns and why we still think that the IMF and global expectations for global growth is still elevated as Europe continues to soften again. So that's what we have for you on the European side. In the next segment, we're going to go deeper into China and what is happening in that region.